Good afternoon, it's Angie from Money and Health UK. Well, it's a brand new tax year here in the UK, and whether you're just starting out or preparing for retirement, it's the perfect time to take stock of your finances. And today, I'll walk you through smart, age-specific tips to make the most of your money in 2025 and 2026. So let's start with advice that applies to everyone, no matter what your age. First, check your tax code. HMRC doesn't always get it right, and an error can mean overpaying tax. Make sure your job status and personal allowance are correct. Next, take a fresh look at your workplace pension. The annual allowance is still £60,000. Even a small increase in contributions now can make a big difference over time. And don't forget to claim tax relief on any professional fees, uniform costs, tools, or working from home expenses. After all, every little helps. And now for one of the smartest tools you might not be using yet: salary sacrifice. Salary sacrifice means you agree to give up a portion of your salary in return for a non-cash benefit, like extra pension contributions, an electric car, or a bike. And here's why it's powerful. Because your salary is technically lower, you pay less income tax and national insurance, and your employer may save on NI too. Here's an example. If you earn £30,000 and sacrifice £2,000 into your pension, your salary drops to £28,000. You pay less tax and your pension grows without needing to take home less. You can also use salary sacrifice to join a cycle to work scheme or lease an electric vehicle. Some employers even offer tech or wellness benefits this way. Do note, however, it's not suitable for everyone, especially if you're close to minimum wage or applying for a mortgage. Always check first. Now let's go through the ages. If you're in your 20s, this is the time to build strong foundations. Stay in your workplace pension. Don't opt out. Starting early can add tens of thousands to your pot. Open a lifetime ISA if you're saving for your first home. You can save up to £4,000 a year, and the government adds 25%. Avoid lifestyle creep. When your income goes up, increase your savings, not just your spending. And here's a post-April tip. Ask your employer about new green or wellness schemes. Some now offer enhanced pension contributions or eco-perks. So you're in your 30s, and your 30s are often about career growth and starting a family, which means more responsibilities and more financial decisions. Check if you're entitled to child benefit again. The income threshold is changing in 2025, so you might now qualify. Consider a private pension, especially if you've had part-time work or gaps from parenting, and plan for rising housing costs. Interest rates may shift, Use your ISA to build a buffer. And here's your post-April tip. ISA and pension allowances are more valuable than ever now that tax-free dividends and capital gains allowances are lower. So, you've reached your 40s, your peak earning time, so use it wisely. 1. Maximise employer benefits like pensions, private healthcare, EV schemes and training budgets. Number 2. Build savings outside your pension too, especially in ISAs. You'll pay more tax on interest and dividends held outside. And number 3, if you've missed pension contributions in recent years, do look into carry forward. You can still use unused allowances from the past 3 years. Here's your post-April tip. Check your state pension forecast online and see if your private savings will close the gap. When you reach your 50s, it's all about getting ahead of retirement without panicking. I remember those times. So let's go through point by point. Number 1, do top up any missing national insurance years. Each one could add $300+ per year to your state pension. And do tackle any remaining high interest debt and check your mortgage rate. Think about a phased retirement, reducing hours while boosting your pension. And here's your post-April tip. From the age of 55, rising to 57 in 2028, you can access your pension. Use flexible drawdown to manage your tax bracket each year. And finally, you're in your 60s. You must look to retire smart. You've worked hard. Now it's all about taking money out wisely. Number 1, only take what you need from your pension each year and try to stay within tax allowances. Number 2, don't rush to take your 25% tax-free lump sum all at once. Consider drawing it gradually. And 3, be mindful of inheritance tax. Large pensions are outside your estate, but ISAs aren't. So do plan how you pass on wealth. And here's your post-April tip. The lifetime allowance has been abolished, but there are still limits on tax-free lump sums. Be sure you understand the new rules. You're in control. Make it count. Whatever your age or income, the 2025-26 tax year is full of opportunity. Small tweaks now can mean big wins later. Do subscribe to Money and Health UK for simple, empowering financial advice. I'll see you again in my next video. Until then, goodbye